Happy Friday. Eric Bible with the Bible team at Neil Home Loans, and a happy Friday indeed as the market was eagerly awaiting this week's highly anticipated consumer price index report, inflation data, and by much relief, it came in below expectations. Definitely more to come on that as I kind of talk through this week's update. But wanted to lead with that is we've started really to see another rally in mortgage rates, and I'm happy to report that the 30-year fix starts the day at 6.99. We've yet again broken above that all important, or broken below, I should say, that all important 7% threshold. And this time feels a little bit different. And I'll get into why that feeling is there, and really we'll kind of open with, now given the fact that we saw unemployment rise unexpectedly last week, this round of inflationary data, the calls and predictions for interest rate cuts from the Fed are starting to reignite. So let's dive into it. So first and foremost, CPI, the all important consumer price index report was released yesterday. And there was a lot of speculation walking into this report again that, much like the last two prints where we saw additional moderation in inflation, this one did not disappoint. And to be more specific, was the first time since May of 2020 we saw an actual decrease, not just in line with expectations, slightly below expectations, an actual negative number on the month over month reading. Markets were anticipating a 0.2% increase on inflation month over month, yet we got a negative 0.1. So a nice beat to say the least. And as I mentioned before, this was the first decrease in inflation since May of 2020. This layering in unemployment unexpectedly rising last week to 4.1%. There's a growing number of pundits, forecasters that are kind of recalibrating their expectations as to when the Fed will start cutting rates. And as we've seen before, no one knows but the Fed. But we can definitely take some of this information and help to intelligently kind of forecast into where we see things go from here. In talking of the Fed, Jerome Powell met or testified, I should say, in front of both the House and Senate Finance Committees earlier this week. It was Tuesday and Wednesday. And again, by no surprise, he stuck to the script. There were no real earth shattering, market moving updates, whether it be in the scripted comments or in the unscripted remarks. But one thing that we absolutely want to focus in on was around the unemployment factor, where again, he mentioned, yes, the Fed is pleased with the progress they've seen on inflation, but they still need more data on the inflation front before rate cuts would be considered. When again asked when they expect rate cuts, he said that timing is still unknown. But from the unemployment piece, he did mention that the Fed is closely watching this segment of the economy. As we saw last Friday with the BLS jobs report, an unexpected rise in unemployment. If this trend continues, he did mention that it could be likely that we see rate cuts come sooner rather than later. So what this tells us, where the Fed goes from here. Market is now fully anticipating upwards of 89% confident on the Fed Watch tool, which kind of forecasts each Fed meeting around rate cuts. It's looking like we will see the first rate cut as early as September. Now, yes, we have a meeting later this month. It's not expected they will do anything with cuts at this meeting, July 31st, but markets will be very acutely aware of, looking for cues, timelines, outwardly expressing, hey, when we expect this to start taking place. And, with that, the trend in interest rates, until we have some additional confidence, as we've seen in past, from the Federal Reserve, or a clear timeline as to when we can expect rate cuts, market's going to kind of remain, I believe, at these levels. We'll see interest rates kind of moderate between that low sevens, kind of high sixes, but really, anyone's guess, and that guess is interest rates go lower once the Fed rate cuts actually start taking place. So yes, it's an evolving situation. We'll continue to monitor and report as new data comes, but really we can take this information to our client now, as this presents an opportunity that, yet again, interest rates have declined. Yes, inventory is moving in the right direction in a lot of pockets throughout the country, specifically here in San Diego. And hey, it's an opportunity for clients to get in before the real chaos begins later this year. As always, let's make it a great Friday and an even greater weekend. Thank you.